In this video, we're going to walk through how we record journal entries for a standard costing system. The concept of a standard costing system was first introduced back in Chapter 7, and we contrasted it with that of a normal accounting system and an actual accounting system. Let's go ahead and take a look at our cost flow diagram to give some framing or context for discussing a standard cost system. Recall when we apply overhead to jobs, we apply overhead typically using our predetermined overhead rate multiplied by an actual activity level. This is what most firms do and is referred to as a normal accounting system. We can also, though, apply overhead using a standard rate and a standard activity level. I should point out here that that standard overhead rate is the same thing as our predetermined overhead rate. Predetermined overhead rate was based on estimated cost and estimated activity levels. That's basically what standards are. So in our normal accounting system, we use a standard rate and an actual activity level. In a standard accounting system, we use that same predetermined overhead rate or standard rate, but this time we multiply it by a standard activity level. That's referred to as a standard accounting system. There's also the actual accounting system, in which we use an actual overhead rate multiplied by an actual activity level. And we discussed the shortfall of that was to come up with an actual overhead rate. We'd have to wait until after the period was over and we had accumulated all of our overhead costs. So again, in a standard accounting system, we use standard rates and standard activity levels. And we're going to use it not to apply just manufacturing overhead, but to track costs throughout our manufacturing process. We will record purchases at standard cost. We will record materials issued into production at standard cost and standard quantities. Direct labor will be applied at standard hours and standard rates, and we'll apply overhead at standard rates and standard activity levels. So our cost in a standard cost system will flow through using standard cost and standard activity levels. Let's go ahead and take a look at that. However, before we do that, let's first look at how we record our transactions in our normal accounting system. So let's go ahead and review that. When we purchase raw materials, we will debit raw materials inventory for the amount of the purchase and credit accounts payable. When we issue materials to production, we use actual quantities and actual costs, and we credit raw materials inventory and debit work in process. When we incur direct labor cost, we debit work in process inventory and credit cash or wages payable or some sort of account. When we incur manufacturing overhead, recall we debit manufacturing overhead and we credit accounts payable. In this case, we've simply said variable manufacturing overhead. We've distinguished it from fixed. We don't have to do that. Then when we apply manufacturing overhead, we credit manufacturing overhead and we debit work in process inventory. And then finally, we need to zero out any over or under applied overhead. In this case, our actual overhead was $73,200. We applied $68,480, so we had underapplied manufacturing overhead, which meant work in process was too low, finished goods was too low, and cost of goods sold was too low. So we end up debiting cost of goods sold and crediting variable manufacturing overhead. So again, that's just a quick review of recording cost in a normal accounting system. Let's begin by calculating our direct material price variance and quantity variances. Recall we had budgeted production of 40,000 and actual production of 44,000. So we need to calculate the standard quantity allowed for 44,000 units. This would be our flexible budget amount. So let's go ahead and begin. Our actual purchases, we're told, $130,560. We purchased 81,600 gallons, and we can, of course, back into the price. Our standard quantity allowed would have been 88,000 gallons. That's our 44,000 actual units of production times 2 gallons per unit. at a standard cost or standard price per gallon of $1.50 for a total standard cost of $132,000, which means our total variance was $1,140. And of course, it was favorable because our actual cost was less than what we would have expected to pay to produce 44,000 units. Filling in our center column, 81,600 gallons at a standard price of $1.50, we would have expected to have paid $122,400 for that many gallons. Our price variance then is 8,160, and of course it's unfavorable because the actual price we paid was higher than our standard price. The quantity variance is 9,600, and of course it is favorable because we used fewer gallons, 81,600, than the 88,000 we would have expected. Let's go ahead now and take a look at the journal entries we record for our standard costing system. First, in purchasing these materials, we of course owe the vendor $130,560. That's how much materials we bought. And again, notice that's coming from our actual quantity purchased times an actual price. We record our raw materials, though, at a standard cost. That would be the 81,600 gallons we purchased at a standard cost of $1.50 per gallon. So we debit raw materials inventory for $122,400. Of course, debits don't equal credits. We need an additional debit, and that will be our unfavorable price variance of $8,160. When we issue materials to production, we issue them at standard cost and standard quantity. That's our $132,000. 88,000 was our standard quantity allowed at a standard cost of $1.50 per gallon. We're going to record a materials quantity variance of 9,600, and we credit raw materials inventory based on the actual quantity we pulled from inventory at the standard price we had it recorded at. And perhaps the better way we want to think about that is we've taken all of the raw materials out of raw materials inventory. So we want to reduce it by 81,600 gallons. And we take it out at the cost that we had it recorded at, which was $1.50. And then notice debits don't equal credits, and so our plug is the materials quantity variance. Now, just like our under or over applied overhead, we need to close out our materials price variance as well as our material quantity variance at the end of the period. Of course, our material price variance has a debit balance, so we'll credit it. Our materials quantity variance has a credit balance, so we need to debit it. So we begin by debiting our materials quantity variance for 9,600. We credit our materials price variance for 81,600, and the difference of $1,140 we credit to cost of goods sold. And again, the intuition behind it is we incurred a cost of $130,000. We actually charged work in process eventually $132,000. So work in process is too high by $1,440. Which meant finished goods was too high by $1,440, which means ultimately cost of goods sold is too high by $1,440. So we close those variances out to cost of goods sold. Of course, we could have prorated it to finished goods inventory as well. Let's take a look at our journal entries now for direct labor variances. Let's begin by completing our variance analysis chart. First, we'll pick up our actual labor cost of $111,280, and that consisted of our employees working 8,560 hours, and of course we can back into our actual labor rate of $13 per hour. Our standard hours allowed would have been 8,800, and again, that's the 44,000 actual units at a standard of 2 hours per unit. our standard labor rate is $14. So we would have expected to spend $123,200 to make these 44,000 units. We actually spent $111,280, so we have a variance of $11,920. And of course, that's a favorable variance since our actual expenditures are less than we would have expected to produce 44,000 units. Finishing off our chart, our actual labor hours were 8,560 at a standard rate of $14 per hour, would have given us $119,840 for our center column. Our rate variance then is the difference between the $119,840 and the $111,280, which is $8,560. We could have also calculated that by taking the difference in the labor rate, 14 minus 13 is $1 an hour, times the actual hours worked. The rate variance, of course, is favorable since our actual rate was less than our standard rate. Our efficiency variance is 3,360, and of course the efficiency variance is also favorable because our actual hours of 8,560 is less than what we would have expected to work, 8,800. And that variance is that difference in hours multiplied by $14 per hour. Let's go ahead now and take a look at our journal entries to record this. Again, actual labor cost, we would have paid cash or hit cash and accounts payable for $111,280. We again record labor at our standard hours and our standard rates. So we would debit work in process for $123,200, which means, of course, we need to pick up the variance. And our variance was comprised of two parts, a rate variance and an efficiency variance. So we will credit the rate variance for $8,560 and credit the efficiency variance as well. At the end of the period, we need to close out the variances. And again, our actual labor cost was $111,000. We recorded work in process of $123,000, which means work in process is too high by $11,000, which work in process is too high. Finished goods will be too high, which means cost of goods sold will be too high. So we're going to need to reduce cost of goods sold by the $11,920. And we do that by debiting our labor rate variance and our labor efficiency variance, and we credit cost of goods sold. Finally, let's record our standard journal entries for a variable manufacturing overhead in our standard cost system. Once again, we'll begin by calculating our price and efficiency variances for variable manufacturing overhead. Our actual variable manufacturing overhead cost was $73,200, and we actually worked 8,560 direct labor hours. We can, of course, back into that actual pretend variable overhead rate. Our standard hours allowed, again, would have been our 44,000 units times 0.2 hours per unit. We're applying overhead based on the 0.2 direct labor hours per unit. And we have a standard rate of $8 per hour. So we would have expected to spend $70,400 for overhead. We spent $73,200. We've got a $2,800 unfavorable variance. Let's go ahead and calculate our price variance. We take our actual hours, multiply it by our standard rate, and our actual hours at the standard rate would have been $68,480, which means our price variance is $4,720. And again, that's simply the difference in the labor rate, 55 cents, times the 8,560 hours. And of course, it's unfavorable since our actual rate is greater than our standard rate. Our efficiency variance is 1,920, and it is favorable because we worked fewer labor hours than we would have expected at standard hours allowed. And again, we could have calculated our labor efficiency variance by taking the difference between the 8,800 and the $5,680, which is $240, and multiplying it by our standard rate of $8 an hour. Let's go ahead and take a look at our journal entries. Again, when we're paying our actual overhead, we're going to credit accounts payable for the actual amount of overhead cost, cash or accounts payable, in the amount of $73,200. Of course, we said we record or apply our manufacturing overhead based on standard hours and standard rates. So we will debit work in process $70,400. The difference, which is comprised of two parts, a price variance and an efficiency variance. We need to record those. We will debit the variable overhead price variance for $4,720, and we will credit our variable manufacturing overhead efficiency variance for $1,920. If you don't remember which is a debit and which is a credit, we can pay attention to our total variance. Our total variance was unfavorable, and we needed an additional $2,800 debit to record an unfavorable variance. So that tells us that the price variance, which is also unfavorable, needs to be recorded with a debit. And of course, that means the efficiency variance will be recorded with a credit. Now, our actual overhead was $73,000. We only applied $70,400. So work in process is too low by $2,800. Finished goods is too low by $2,800, which means cost of goods sold is too low by $2,800. So we're going to need to debit or increase cost of goods sold by $2,800. And then, of course, we need to close out our variable manufacturing price variance and our variable overhead efficiency variance. To close out the price variance, which has a debit balance, we will need to credit it. And to close out the efficiency variance with a credit balance, we need to debit it. And we've zeroed out our price variances. And that is how we record journal entries in a standard cost system.